In this lecture, we will cover the CFA Level 2 reading on inventories. This reading takes off where the Level 1 reading on inventories ended. In Level 1, we talked about basic concepts related to inventories. And what we'll do here is first a quick refresher of the different inventory valuation methods that will be covered in section 2. Then the core focus of this reading is to compare companies which follow a method called LIFO with companies that follow FIFO. And to do that comparison, what you have to do is take LIFO numbers and convert them into FIFO. So a company using LIFO will report a certain inventory. How do you convert that into FIFO? How do you convert LIFO COGS into FIFO cost of goods sold? How do you convert retained earnings numbers? How do you convert profit numbers? So that material was not covered at level 1. It will be covered in detail over here. Another important aspect of this reading is analysis. So when you are comparing companies which use different methods, how do you compare the ratios? And that again is something that you will do in this reading. All right, let's start with the basics, and this should look familiar. Inventory and changing price levels. As you saw at level 1, there are different inventory valuation methods, and those methods are as follows. FIFO, or first in, first out. With this method, the assumption is that items which are purchased first are sold first. And I'll give a small illustration of how these different methods work. The next method is LIFO, last in, first out. This method is only allowed under US GAAP. It is not allowed under IFRS. Then we have weighted average cost, which we discussed in detail at level 1. Level 2 doesn't spend too much time on this method. And then finally, specific identification. Again, we talked about this at level 1. Here, what we are essentially doing is saying that every item is costed based on its individual cost. And this would be used when you are selling precious material, for example. If you are selling diamonds, then every diamond has its own cost. Now, I'm going to give you a simple method to distinguish between the two most important methods here, which are FIFO and LIFO. And when I say most important, it's most important in the context of this particular reading. Here is a simple framework to keep in mind. When a company buys goods, it is probably buying at different prices. If you have an environment of rising prices, then goods that are bought first are at a lower price, goods that are bought afterwards are at a higher price. So if you take a very simple scenario where a company over a period of time buys 4 times. First it pays $1, then again it pays $1 for the next item, then it pays $2 and $2. So I call this the 1122 model. What happens with the FIFO method? With the FIFO method, we are saying that the first in items, the 1 and the 1, these are sold first. If these are sold first, then what is the cost of goods sold? It is going to be 1 plus 1, which is 2. And what is the ending inventory? It is based on 2 plus 2, which is 4. So in FIFO, you are selling these first. In LIFO, you are selling the second 2 and 2 first. So what is the impact on COGS and inventory balance of these two methods? When you have this framework in mind, it's very simple to understand what's going on. With FIFO, your COGS is going to be low. So that's given over here. So when we say low high, we are comparing FIFO COGS and LIFO COGS. So COGS is going to be low with FIFO and high with last in, first out. Inventory balance is going to be the other way around. It's going to be low with LIFO and high with FIFO. If you want to remember this, then just remember that inventory balance low with LIFO, L for low, L for LIFO. If you remember that, then everything else just falls in place, because then FIFO inventory will be high and then the COGS is the other way around. All right, so keep that in mind. Once you know these two factors, then the others should also fall into place. If you think about earnings before taxes and earnings after taxes, with LIFO, the COGS or the cost is high. That cost is showing up on the income statement. If the cost is high, then the earnings will be low. So that's why LIFO earnings are low. If the earnings are low, then the taxes will also be low, right? If the taxes are low, then the cash flow, which is after tax, is going to be high for LIFO. This illustrates why companies in the US which are allowed to use LIFO will often use the LIFO method, because this allows them to pay lower taxes. The rest of the world mostly uses IFRS, where LIFO is not an option. The current assets minus current liabilities, working capital, will also be lower with LIFO, because current liabilities are not impacted by the inventory valuation method. But current assets obviously includes inventory. If inventory is lower with LIFO, then current assets minus current liabilities will be lower with LIFO. So this is an important little table. It is exactly what you saw at level 1, and it is something that you need to remember. A few other points. FIFO is better for the balance sheet. What does this mean? With FIFO, your inventory numbers reflect current prices, and obviously on the balance sheet you are showing inventory numbers. So FIFO is better for the balance sheet, whereas LIFO is better for the income statement. With LIFO, the cost of goods sold represents current costs, or is closer to current costs. So LIFO is better for the income statement. And another general remark, we have these different methods. The SEC does not require that companies use the same method for all types of inventory. What that means is that if you are selling a particular set of products, you are allowed to use the FIFO method for one set of products and LIFO method for another set of products, as long as you can justify why you are doing this. So keep this in mind. There is a question at the end which tests you on this. Now what I want you to do is attempt example 1, which shows the impact of inflation using LIFO and comparing that to FIFO. This is a fairly straightforward question, but it requires a little bit of time. So I want you to read this, think about how it will be done, and I'll then go through the numbers. The idea here is that you have two companies, L and F. L stands for LIFO and F stands for FIFO. These two companies are doing the exact same type of business. So this is a made-up scenario which illustrates the fact that simply by using different inventory methods, there will be different numbers reported on the financial statements. What I'm going to do here is actually just show you the answers, and then I'll make a separate video available where all the calculations are done. Key point is that we are comparing the LIFO company with the FIFO company. And as I described earlier, we are going to look at the impact on inventory, cost of goods sold, and then the impact on profit. The impact based on which inventory method is used. Does it surprise you that the sales numbers are the same for both companies? It should not, because the sales method is not impacted by the inventory valuation method. But ending inventory is going to be different for the two methods. If you take the LIFO company, then the ending inventory throughout is 16,000. But with the FIFO company, the ending inventory number is higher, right? So with FIFO, ending inventory is higher. With LIFO, the ending inventory number is actually lower, and we talked about why that is the case. These numbers also are showing you the same fact. This happens in an environment where prices are going up. If prices are going down, then we would have the opposite. All right, what about cost of goods sold? If you notice, the COGS number, 274,000, is higher than the COGS number with FIFO. So this means that COGS over here is higher, which again is what we saw earlier. The exact calculation of these numbers again is in the curriculum, and I'll also make a video available which shows the calculation, but I'd say the calculation is mechanical and straightforward. What about gross profit? Since the gross profit number is given by sales minus cost of goods sold, if the sales numbers are the same and COGS is higher for LIFO, then the gross profit is going to be lower for the LIFO firm. So at this stage, make sure you understand the concept, and then you can go back, do the working, and understand the mechanics. What about some basic ratios? The inventory turnover ratio and the gross profit margin. As a side remark, if you look at your level 2 book, right at the start of the book, there is a laundry list of ratios. All those ratios are ratios that you studied at level 1 and you should have learned at level 1. You are expected to know those ratios coming into level 2. So one of the first things you should do is go through that list and make sure you know it well. All right, so what is the inventory turnover ratio? It is COGS divided by inventory. In some books, it will be average inventory, or it might be ending inventory. You can look at the context and figure out what is being used. Now, we are going to compare the inventory turnover ratio for the two companies, which are similar in all regards, except that they are using a different method. Let's take the LIFO company. Will LIFO have higher COGS? We've talked about the fact that LIFO, in an environment where prices are rising, LIFO will have higher COGS because it's the last in product which is being sold. What about the inventory numbers for LIFO? The inventory numbers will be lower, so the overall ratio for LIFO will be higher, and that's what you are seeing over here. The inventory turnover numbers for the LIFO company are higher. So if you simply just look at these numbers, which company seems to be performing better? The LIFO company seems to be operating better because a higher turnover ratio indicates better or more streamlined operations. But is that really the case? It is not. Okay, so this is just setting you up for the fact that you need to do some adjustments which will come later. What about the gross profit margin? That is equal to gross profit divided by sales. The sales number is the same for both methods. What about the gross profit? The gross profit is going to be, so I should actually do this over here under the LIFO company. So gross profit over sales. The gross profit for the LIFO company is lower. The sales numbers are the same regardless of the method. So the gross profit margin is actually going to be low. All right, and you see that over here, just a little bit lower, but still lower nevertheless. Okay, so these are important points. And again, the calculation of these numbers is mechanical and straightforward, but the separate video will explain the calculations. They are also given in the curriculum. Now we come to one of the most important aspects of this reading, which is to understand the LIFO method and how to convert LIFO numbers into FIFO numbers. As I mentioned before, LIFO is permitted under US GAAP and it is not permitted under IFRS. There is a rule called the LIFO conformity rule, which is very important. And this rule says that the same method must be used for tax reporting and financial reporting. In other words, if you are using LIFO for your financial reporting, then that same method is used for tax reporting. This is different from depreciation. With depreciation, you are allowed to use straight line method or whatever method is appropriate for financial reporting, and a different method for tax reporting. Okay, now in this particular case, if a company wants to reduce its taxes, it can use the LIFO method in the United States because that's where it is allowed. LIFO method reduces earnings before tax and then reduces taxes. I mentioned this before also. However, companies which use the LIFO method must also disclose something called the LIFO reserve. LIFO reserve is the difference between inventory reported at FIFO versus inventory if it were reported using the LIFO method. This particular section, section 3, has two subsections. Section 3.1 will get into the details of LIFO reserve, and then section 3.2 will deal with LIFO liquidations. Let's do 3.1, LIFO reserve. Here is the formal definition of the LIFO reserve. It is the difference between the reported LIFO inventory carrying amount and the inventory amount that would have been reported if the FIFO method had been used. US GAAP requires that if you do use LIFO numbers, then in the footnotes you disclose the LIFO reserve so that financial analysts can easily convert from LIFO numbers to FIFO numbers. This LIFO reserve is extremely important in several adjustment related calculations that you will need to make. You look at the balance sheet of a company that is using the LIFO method. The inventory number shown on the balance sheet is the inventory number that is calculated based on LIFO. So how do you convert that into FIFO inventory, or inventory that would have been reported if the company had used FIFO? Just looking at this definition, all you need to do is add the LIFO reserve number. So if the reported number is 150 and in the footnotes you see that the LIFO reserve is 25, then you simply say that the FIFO inventory is 175. Then you go to the income statement and you want to convert the reported COGS number from LIFO to FIFO. If the reported COGS number, let's say, is 100, since the company is using LIFO, the reported number is based on LIFO. How do you convert this to FIFO? What you do is the following. You take the LIFO COGS as your starting point and then you subtract the change in LIFO reserve. Change in LIFO reserve is the ending LIFO reserve minus the beginning LIFO reserve. If your LIFO reserve at the end of the period is 25 and the LIFO reserve at the beginning of the period is 20, then what is the change in LIFO reserve? That change is 5 and you will have FIFO COGS of 95. So fairly straightforward. We call this number, the FIFO COGS, an adjusted number. So if you look at the terminology in the curriculum, they will call this the adjusted COGS. And this term adjusted, though, has several meanings. There will be another context, and this will show up in one of the questions at the back, where inventory write-downs also impact COGS. And at times you as an analyst might want to say, okay, what is COGS without the inventory write-down? And that also is called an adjustment. I'm just mentioning this over here, but I'll cover it in more detail later. Next point. Obviously, you might also want to look at the impact on net income. If you are comparing the net income of two companies or you are comparing ratios such as net profit margin and so on, where net income is required, then you need to make a net income conversion. FIFO net income is equal to LIFO net income plus the change in LIFO reserve into 1 minus the tax rate. So you need to remember this relationship. And then the FIFO retained earnings is equal to LIFO retained earnings plus LIFO reserve into 1 minus T. There are several relationships here, and I'll suggest a method for remembering all these relationships. This one is easy. Why? Because this is simply the definition. Also note that there are two relationships here which are balance sheet based, and there are two relationships which are income statement based. The top one is a balance sheet relationship, and the bottom one is a balance sheet relationship. The balance sheet reports cumulative numbers in the sense that you are looking at your total inventory at a given point in time, or your total accumulated retained earnings. With balance sheet related calculations, we use the ending value of the LIFO reserve. And then obviously with retained earnings, there's going to be a tax impact, so you do 1 minus T. The middle two expressions here are related to the income statement. Whenever you are dealing with the income statement, there you consider the change in LIFO reserve. So notice that there is a change in LIFO reserve. So this will help you remember where to use the LIFO reserve versus where to use the change. That's point number one. Point number two is where do you plus and where do you minus? Because it is easy to imagine questions which are testing you as to whether you know whether to plus or minus. Okay. Hopefully you recognize the fact that in an environment of rising prices, which is the typical environment, FIFO inventory is going to be more than LIFO inventory. So that's why you have a plus sign. You also recognize that in the typical environment where prices are rising, FIFO COGS will be lower than LIFO COGS. So that explains the minus sign. FIFO net income is going to be higher. So that explains the plus. If net income is higher, then retained earnings will also be higher. So that explains the plus. And then the third point, how do you remember this 1 minus T? Obviously, if your income is going to be higher, there is also going to be a higher tax. So the impact of tax needs to be taken out. And that's where the 1 minus T comes into play. So if you remember those three facts, which you actually knew already, then all these relationships will be easy to remember. We will now consider example 2, and I'll make some high-level remarks in this lecture. Then we will also make available a detailed video on the calculations that you need to do. But my suggestion would be that you try to do the calculations first before looking at the solution in the curriculum or the solution in the video. The high-level context here is that we are studying a company called Caterpillar, which is based in the United States and uses the LIFO method. And what we need to do is convert the LIFO numbers into FIFO numbers. We will be using the relationships that we just talked about. If you look at the first question, what inventory value would Caterpillar report for these years if it had used the FIFO method instead of the LIFO method? So what relationship do we use? We simply use the relationship which says that FIFO inventory is equal to LIFO inventory plus the LIFO reserve. So I'm not using the numbers here. I want you to look through the material, get those numbers and get your answer. Then the next question is, what amount would Caterpillar's cost of goods sold for these years be if it had used the FIFO method instead of the LIFO method? Here again we use the relationship which we just saw. So FIFO COGS is equal to LIFO COGS minus the change in LIFO reserve, and you will get those numbers from the financial statements. Next question, what net income would Caterpillar report if it had used the FIFO method? Again, we've talked about this relationship. The FIFO net income is equal to the LIFO net income plus the change in LIFO reserve into 1 minus the tax rate. Moving on, by what amount would Caterpillar's net cash flows from operating activities decline if it had used the FIFO method? Now remember, the change in actual cash flow exists only because of differences in the tax paid. Right? That is the only reason why there will be a difference in the cash flow of a LIFO company or a FIFO company. All right, so now let's look at that in a little more detail. If you consider the scenario, what is the difference in the gross profits? Is there a difference in gross profits? There is. That difference in gross profits is given by the change in LIFO reserve, because the change in LIFO reserve impacts the COGS numbers. So what you are going to do here is look at the change in LIFO reserve and multiply this by the tax number. So it is as straightforward as that. It looks complicated, but when you do this calculation, you are going to get the impact on the cash flow. So some of you might be confused by the explanation I just gave, so I'll just very quickly summarize what we are talking about. There is a certain LIFO COGS that is reported. Under FIFO, the COGS is going to be lower, but lower by how much? It's going to be lower by the change in LIFO reserve, which then means that the gross profit or the profit before tax also will be higher by this amount. If that is the case, then there will be more taxes, and those taxes then are given by the change in LIFO reserve multiplied by the tax rate. Next point. What is the cumulative amount of tax savings that Caterpillar has generated through 2008? When we talk about the cumulative amount of tax savings, then all we need to do is take the LIFO reserve, the total accumulated LIFO reserve, and multiply that by the tax rate. That is the overall savings achieved so far. Next question. What amount would be added to Caterpillar's retained earnings at the end of 2008 if Caterpillar had used the FIFO method? And here again, we've actually talked about the relationship before. The FIFO retained earnings would be equal to LIFO retained earnings plus the LIFO reserve into 1 minus T. In case you were thinking change in LIFO reserve, that would not be correct because we are talking about a balance sheet number here. Next point. What would be the change in the cash balance if Caterpillar had used the FIFO method instead of the LIFO method? All we are saying here now is that the change in cash balance would be based on the additional taxes paid, and the total amount of additional taxes paid would be equal to the LIFO reserve into the tax rate. Are we talking about a balance sheet item here or an income statement item? The cash balance is clearly a balance sheet item, so that's why we are looking at the overall LIFO reserve and not at the change in LIFO reserve. The final question asks us to compare several ratios, and that we will do over here. From a testability perspective, this is extremely important. We have touched on this already. Inventory turnover ratio is COGS over inventory. You can look at the numbers in the curriculum, but as we've discussed before, the LIFO number will be higher. We've discussed this in example 1 also. Days of inventory on hand. If you remember from level 1, and if you look at the expressions or the formulas at the start of FRA, this is 365 over inventory turnover. So it is going to essentially mean, this is going to mean that if you have a high turnover number, then the days of inventory will be lower. Gross profit margin we've also talked about earlier. The LIFO gross profit margin is going to be lower relative to the FIFO number. What about net profit margin? This is also going to be lower because the profit is lower. The sales number is going to be the same. The next item is return on assets, net income over assets. The net income is going to be lower with LIFO. What about assets? Assets will also be lower. But if you think about it, net income in percentage terms will be substantially lower relative to the difference in assets. Inventory typically would be a small percentage of overall assets. So the assets number is lower with the LIFO method, but only by a small amount. The impact on net income typically will be more substantial. So if the net income, which is in the numerator, has the larger impact, then what is going to happen to the overall ratio? It is going to be lower with the LIFO method. And that is what you see over here. The current ratio is current assets over current liabilities. Current liabilities would be the same for both methods. What about current assets? Lower for LIFO, and that's what you see over here. Total liabilities to equity ratio, this is important. So you have total liabilities over equity. The liabilities number would be the same, but what about equity number? Here you need to remember your fundamental accounting relationship, that assets is equal to liabilities plus equity. If the liabilities number is the same regardless of the method, then equity would be lower if assets are lower, which would then imply that with the LIFO method, the equity number is lower and the overall ratio would be higher, which is what you see over here. All right. Make sure you understand the concept and then also try to do the calculations from the curriculum. We now move to section 3.2, which deals with LIFO liquidations. Before I come to the definition of LIFO liquidations, I'll just give you some high-level points. In periods of rising inventory, the carrying amount of inventory under FIFO will exceed the carrying amount of inventory under LIFO. And I'll give you a very straightforward example to illustrate this point. Let's say that you are buying inventory and you first buy at $1 a piece, then you are buying at $2 a piece, then you are buying at $3 a piece. So this is time. In periods of rising inventory, which means that your inventory balances are increasing, and let's say that you are using the FIFO method. If you are using the FIFO method, then you are selling the low cost inventory. Your inventory balances are rising, which means that inventories that are valued higher, those balances are rising. So the difference between FIFO and LIFO keeps increasing. And the difference between FIFO and LIFO is the LIFO reserve. So that is the straightforward point being made over here. So these are two sub-points that you need to remember. The LIFO reserve may increase for two reasons: increasing difference between older costs used to value inventory under LIFO and more recent costs used to value inventory under FIFO. So that's illustrated by this simple example. Also, the number of units manufactured or purchased exceeds the number of units sold. So if these two things are happening, then you have an increase in LIFO reserve. LIFO liquidation refers to the opposite scenario. If you have a situation where the number of units sold exceeds units purchased or manufactured, then you have LIFO liquidation. Now coming back to this scenario, A company is using LIFO and the units being sold exceeds the units being purchased or manufactured. That means that a company then is dipping into these older layers, and a company might be selling over here, but now the COGS is indicating that you are selling inventory that is only worth $1. So this is called LIFO liquidation, where you are dipping into old cost or low cost inventory. What will that do to your COGS? It will make the COGS appear low relative to current prices. And what will that do to gross profit? It will make the gross profit look high. But will this high gross profit be a good indication of what you can expect in the future? No, because in the future, obviously, you'll be buying at current prices. So as an analyst, if you observe a decrease in the LIFO reserve, then that is a warning sign that the current profits are higher than what you can expect in the future. This can also be used by management to manipulate earnings. If management wants to show higher earnings, then potentially they can do things that allow them to dip into old inventory. So you as an analyst need to be careful whenever you see LIFO reserves decreasing. Example 4 in the curriculum illustrates this concept, and there's a separate video that talks about this example in detail. What I'll do here is just show you a very fast way of dealing with this problem. What you can do very briefly is pause this video and read the example and try to solve it, and then I'll give you a quick solution. With a question like this, the first thing you need to consider is what is being asked. And here is what is being asked. What amount of RF's 2009 gross profit is due to LIFO liquidation? So what is the 2009 gross profit? That's given right here. Is some of this coming from LIFO reserve, and if so, how much? Now, when you are dealing with LIFO reserve, you need to compare units purchased with units sold. Notice that the units purchased are consistently 12,000. Initially, the units sold were 10,000. And then that means that you still have 2,000 left, valued at this low price of 100. Then in the next year, 12,000 were sold and 12,000 were purchased, which means that these cancelled each other out. We are using LIFO, so these are the last in and we are selling the last in. Same thing happens in 2008. But then in 2009, we purchase 12,000 and sell 13,000. So now you are going to dip into this inventory. So 1,000 are coming from inventory which was valued at 100. What is the current price of fans? The cost is 115. So the difference is 15. That 15 is multiplied by the 1,000 because you are dipping into old inventory worth 1,000. So 15 times 1,000 is 15,000, which means that 15,000 of this gross profit number is coming due to LIFO liquidation. All right, there is a longer explanation that will be made available in a separate video, but this should be good enough. As a general point here, sometimes you will be given a tremendous amount of information, but if you understand the question and your concept is clear, then you can solve the problem quite fast. This is the somewhat long-winded solution given in the curriculum, but I think the solution that I gave you just now is fairly easy to understand. All right, now here is a quick check of whether you are understanding what's going on. I want you to think about this, come up with an answer before I give you the answer. All right, okay, so The correct answer is company A. And how do we know this? First of all, when you have LIFO versus FIFO and you are talking about a balance sheet and you are talking about an income statement item, immediately you know that it's going to be LIFO and not FIFO. Then you also need to consider what's happening to the LIFO reserve. A decrease in LIFO reserve means that there is LIFO liquidation taking place and COGS is reflecting old prices because we are dipping into older layers. So that would mean that between A and C, company A is the better answer. So fairly important. You might see questions like this at the end of this reading.